Look at this question, required part A, we are told to distinguish between risk and uncertainty as used in investment, appraisal. You have 4 marks, so you need like 4 points. Then also you distinguish with examples between systematic and unsystematic risks. So you have also 4 marks, those are 8. So how do you respond to this? Part A of the question. I can do in a table format for me, but for you in an exam, you can use the paragraphs. You can use the paragraphs. So here you have the factor. Here you have the factor, okay, or the parameter, the basis. I can call it the basis. I can call this one the risk. Then I call this one the uncertainty. Okay. You need like 4 points. You need like 4 points. You need like 4 points. So when you're looking at a definition, for example, if you are looking at the definition, what is risk? What is uncertainty? The meaning of these two. As your first point. So the risk refers to this refers to situations where the future outcomes are known, but their actual occurrence is probabilistic. Their occurrence is based on, I can say their occurrence is based on the probability. That is about the risk. The actual occurrence is based on what? On probability. That is about the risk. What about uncertainty? Uncertainty, here you can say with uncertainty, you can say that uncertainty refers to situations. This refers to situations where the future outcomes are completely unknown. And probabilities cannot be assigned. Probabilities cannot be assigned. That is uncertainty. You don't know the future. You don't know the future outcome. And then it means that it is hard to even assign the what? It is even hard to assign the probabilities. So when you're responding to this question, at least that should be your first point. You may not use the table in an exam. You can use the paragraphs. You say risk refers to a situation where future outcomes are known, but their actual occurrence is based on probability. While uncertainty refers to a situation where after that you go to the next point. You go to the next point. For you in an exam, you may not use the table, but if you use the table, also well and good. Well and good. Then point number two. Point number two. Point number two, you can talk about the measurement. Point number two, you can talk about the measurement. You can easily measure the risk. You also know that we can measure the risk. This risk can be measured. It can be measured. It can be measured. It can be measured using statistical statistical tools. Can be measured using statistical tools. For example, we normally use what? Standard deviation. Standard deviation. We normally use like standard deviation. We can use, we normally use even the sensitivity analysis, we can even use, you normally here we use, sometimes you use sensitivity. Sensitivity. Sometimes you normally see we use the variance. If you have not used the standard deviation, but more appropriately, it is more appropriate when we use standard deviation. So that is about risk. It can be measured. It can be measured. But when it comes to uncertainty, when it comes to uncertainty, how can you measure that in the next month there will be floods? Those are things that are beyond the what? Beyond the control. Now here you will say that it cannot be measured. It cannot be measured using statistics. Using statistics here. Because the outcomes and the probabilities are completely unknown. So that is the point number two. You can measure. You can measure the risk, but you cannot measure the uncertainty using these statistical tools. That is point number two. Then next. How do we make a decision based on this? How do we make a decision? Basis of the decision making here. As you make the decision here, decisions can be here. With risk, decisions are based on probabilities and calculated outcomes. But when it comes to uncertainty, it's something which is judgmental for okay. I can say that decisions rely on judgment or assumptions. You cannot really based on the calculated outcomes. You are just going to rely on the assumptions, maybe based on the past scenarios, based on past scenarios, like the way you normally know that whenever it rains, there is always the issue around what? There is always the issue around they call it what? Kasemba. So, but it is something that is what? That is judgmental. You can it's just an assumption. It's just an assumption. It's not something that you're going to base on the probabilities or what? on the calculated outcomes. Then what about the control? What about the control level? When you're looking at risk, management can actually control this. Management can partially control or reduce the risk. But when it comes to uncertainty, it cannot be controlled. It cannot be controlled or reduced by management. It is something that is not within your control, but risk is within your control. You can at least reduce or control it. You get? So when you're looking at, let's say, for example, the market examples here, if you're to look at maybe some of the examples, you look at the competitive risk. If it is competitive risks. For example, here you're talking about new competitors. You're talking about new competitors may enter with known probability. But when it comes to uncertainty, for example, here you may talk about the sudden war or the pandemic. Here there is the examples with no predictable probability. There is no way you can say, now in Uganda we will have a war in this particular period. These are something that are beyond your control. There is no way you can predict that. But it's something that can happen. It's something that can happen. There was a pandemic. The pandemic you cannot predict. And put the probability. So we have. I don't want to be. I know you have this handout. I believe you have all this. Okay. You have all this. Okay, that is about. But we have many points. We have many points when we talk about insurance. Now, how can you reduce risk? You can decide to insure. Insure you get the insurance policy. But when it comes to uncertainty, it cannot be insured. Political changes. Those ones may not be insured. So that is about. I don't want to waste time here, but you will put more points. You will put more points. But the point that you can recall is about the source. The source is that this is usually internal. This is usually internal or market driven. Like the cost overruns, the price changes. That one can cause risk. But when it comes to this is usually external. This is usually external. For example, talk about the political shifts, talk about the technological disruptions. These days we talk about AI. Talk about the natural disasters, the drought, the floods, among others. So those ones are external. Okay. So that is about A. You just put 4 points. The reason why I'm talking about during our time it used to be common, but I believe they still ask this. as you can see in your paper. Okay, so next we'll part B. We are talking about part B. We are told to distinguish with examples this systematic and unsystematic. Systematic and unsystematic. You have 4 marks. So what are you going to do? What are you going to do here? What are you going to do? Now, guys, before there is a point here which is good. For exam purposes, I know these points are always easy to recall, especially when you meet a question like this. There is a point about the decision technique. The decision technique. The decision technique. We normally use for risk. We normally use expected. We normally use expected monetary value. Monetary value, that is EMV, can be used. The method used can be used. The method can be used. But when it comes to uncertainty, the method that we can rely on, because we are not relying on the probabilities. Have you ever heard about max? These things, max mean. Have you ever heard about this and minimax? You only apply these techniques in a scenario where you have no probability. So these are the techniques that can be used when you are handling a situation without probability. I believe these ones are easy to recall. Recall. Okay. Then next. Okay. So one, you look at the definition, the meaning, the definition. The meaning, when it comes to systematic, this is a risk. Systematic risk is a risk that affects the entire market or economy. Or entire market or economy. Okay. Then here it's a risk. It's a risk that affects a specific company. Here you are looking at a single company, one company. But if it's a systematic, it is going to affect all companies within that sector. But when it is unsystematic, or industry here. When it is unsystematic, you're looking at a specific industry or a specific company. But with systematic, generally it will affect almost the entire market. For example, when you are looking at for example, here we may also add for example, here, examples that you may talk about, it could be like, because they said with examples, it could be like inflation. When we are saying inflation does not affect the specific industry. It actually affects the entire market. If there is a general increase in the prices of these goods or commodities, everyone will be affected. Not a specific industry. Inflation, interest rate, all these ones affect almost the entire interest rate changes. Even the exchange rates. You saw the dollar, how the dollar was depreciating here in Uganda. So those guys who had investments, you'll be affected. You'll be affected. The exchange rate, these exchange rate movements, the interest rates, the inflation, all these ones affect the entire economy. They affect the entire economy, not specifically one industry. But when it comes to unsystematic risk, these ones come from the management. It could be the poor management. The poor management, it could be as a result of poor management. It could be as a result of fire. It could be as a result of strike, a strike, strike. It could be the disruptions in your one of the machinery. Among others. So that is about unsystematic. Then when it comes to measurement, does it fit here? Okay, measurement tools. Yeah. Measurement tools. If I'm to measure the systematic risk, measurement tools. I can use measurement tools. I can use what? I can use, we are going to see these things like beta. You can use like CAPAM, capital asset pricing model. You can use the risk adjusted discount rate, among others. But here, when you're talking about unsystematic risk, here company risk analysis. Here you have to use the company risk analysis. Specifically, how you analyze may depend on your model, the model you use. It could be the credit risk management, or risk assessment. It could be about, you may analyze using the SWOT analysis. You look at the strengths, weakness, opportunities, and threats. Okay, that's how you can measure and you come up with appropriate. Then the nature of the cause. Here you are talking about external factors, either external factors which are outside caused by external factors. This is outside the company's control. Then when it comes to this unsystematic, this is internal factors caused by internal factors largely within the company's control. If it is about strike, as a company, you have a control. You could have controlled that. If it's poor management, you have a control. You can hire the qualified people. If it's fire issues related to fire, you can come up with appropriate measures. Okay, to minimize that. Okay. We can also talk about the diversification bit of it, the diversification effect, the diversification as another point. The diversification here, we can say that here it cannot be eliminated by diversification. Cannot be eliminated by diversification. Then here it can be eliminated can be eliminated or minimized. We cannot say eliminated, can be controlled. Can be controlled or minimized. Because it may not be eliminated entirely. Minimized through diversification. So what does this one mean? We have another name for these things. Another name. If you don't have maybe other points, you can say another name for this is market risk or non-diversifiable risk. Non-diversifiable risk. Then here, another name is that it is called the specific risk or diversifiable risk. Those days I used it to cram it, and I know that where you have unsystematic, it is the other way around. It's the other way around now. Where there is unsystematic, it is diversified. Then there, where there is systematic, it is undiversifiable risk. The other way around. But diversification means means what? You can decide to come up with to invest in different projects. Maybe let's say you're running a school. There is those risks that can affect specifically the school. So now, if I want to diversify, I can decide to invest in other sector or in other industry, not in line with the education sector. I can decide to maybe go into manufacturing. I diversify by just investing in what? In manufacturing. The reason why we are saying that systematic risk cannot be eliminated by diversification is that this one is going to be it's going to affect the entire market. It's going to affect, because even if you are in manufacturing or education, inflation will affect you. These interest rate changes will affect you indirectly. The exchange rates will affect you indirectly. The only way you can minimize on systematic risk is through what we call hedging. I know you guys, one of your topic is also international financial market, rather financial management, where you talk about hedging, and you're going to look at, let's say, a forward contract, you're going to look at money market hedge. Those ones can help you to eliminate the risk. When you go deep, we are going to be talking about, you'll be hearing things like interest rate swaps to mitigate the risk, interest rate features, interest rate options. If you dig deep, all those ones can help you to eliminate at least these risks. Okay. So if they ask you the ways you can eliminate the systematic risk, you probably need to put those points. Hedging techniques. Okay. I think these points are enough, but I have many points really. I have many points, but I don't want to. We have how many? 1, 2, 3, 4, 5. Only. Let's add the. We have already talked about control. Money can, okay. We have already talked about we can talk about the beta, because here, if points are not there, you can also talk about the beta. The beta bit of it, the beta relationship. beta is greater than 1, if beta is greater than 1, there is always high systematic, there is always high systematic risk. The market risk is high. We are going to see, I saw some of the questions in your past paper talking about this. If we are going to see that if the market risk, if the beta is greater than 1, then the market risk or the systematic risk is high. But when it comes to this thing of unsystematic, it cannot be measured. Here you will just say beta does not measure. Beta does not what? Beta does not measure. Beta does not measure unsystematic risk. Then the compensation, the last point, I think for now, I am going to say that beta, the compensation. I can talk about the compensation, whereby I'm going to say that here, investors expect a risk premium. A risk premium for bearing systematic risk. For bearing risk premium, I hope it is not the first time. It is not the first time to hear about this risk premium. RM minus RF. Have you ever heard about that when you're looking at CAPAM? RM minus RF. That is risk premium. RM minus RF. That is risk premium. So that is just the compensation when you decide to take a systematic risk. You expect the risk premium, which is RM minus RF. But when it comes to the other, usually not compensated because it can be diversified. It can be diversified away. In short, you can eliminate it. You can eliminate it. It can be eliminated or controlled or reduced, depending on how you want it. If it cannot be eliminated, then you reduce it. Okay. I think those are enough points. Eliminated. I think those are enough points for you to pass. This is also a common area in a paper. It is also a common area. How can you mitigate? The question may come asking you, how can you mitigate unsystematic risk? How can you mitigate unsystematic risk? I believe now you can handle if it is unsystematic, then we can use hedging techniques. So think about all the hedging techniques to mitigate the systematic risk. Then if it's about unsystematic risk can be eliminated or controlled using you can diversify. It can be eliminated through diversification. I decided to invest in different projects, which are not in the same line. But because it is also as internal issue, I can make sure that internal controls are okay. Among others. So that's all. Then next, we are told Mikodo Limited is considering launching a new product and has And has what? Just a minute. Okay, I'm back. And has a new is considering launching a new product and has generated the following data of expected cash flows. Let me hope the screen is visible. The following data of the expected cash flow. The appropriate discount rate has been applied, and below are the present. You have the present values in this question. You have the present values. You have the present value of the sales revenue. You have the present value of the variable costs. And now you get the sales revenue minus. This was really spoon feeding. I don't think that they can ask this again. But anyway, who knows? Okay, so, but this is really spoon feeding. The examiner has helped you with all the information. Sometimes you find that you're the one to get these present values. Finally, you're the one to get these present values. Okay, you have the present value of sales revenue, you have the present value of variable costs, and then you have the contribution by getting sales revenue minus variable costs. Then you have fixed costs. You have the fixed costs. You have the present value of the, now when you get the contribution minus the fixed costs, you're getting the operating income. You're getting the operating income. But also the examiner has given you the what? The examiner has given you the initial investment. Okay, then overall you have the present value. Present value, net present value. You get the total revenue minus the total costs. Then minus your initial investment. Okay, here we need the sensitivity. How sensitive is that variable to NPV? How is it sensitive? Sensitive in a way that any slight mistake, your NPV can change. For example, here we are saying you have NPV, which is positive. You are all aware from your financial management paper, you studied that if NPV is positive, you recommend the management to undertake the project. You are all aware that if NPV is positive, the management should go ahead and undertake the project because it is viable, because it will add the value to the shareholders. Okay, now the question is now, if there is a change in revenue, how is that change sensitive to NPV? Will you still consider investing in that project or not? Okay, so here you have the question like this. 10 marks. There are some times where a lecturer wants his or her students to pass. But of course, lecturers are good. They always want students to pass. They always want students to pass. Okay, here what we are going to do with this kind of question, because you're given NPV, you're given any NPV. So because I'm given NPV, for me, what I'm going to do, I am going to say that the sensitivity, you will need let me hope I have explained what sensitivity is. Let me hope I have explained what sensitivity is. But the sensitivity is just the change. Okay. As I answer this, I am going to get the percentage change. The percentage change as I answer this, because I'm given already NPV. Percentage change, you get your NPV. You get your NPV. Which screen are you seeing? Which screen are you seeing? Just someone I can confirm, can help me. You're the one who is seeing the screen, eh? So you tell me, pardon?
Percentage change.
Okay, percentage change is equal to the NPV of the project, then over the PV, the present value of the test variable, or estimate, then times 100. That's how we are going to know the sensitivity or the change. Okay. Now, if I'm looking at a variable like this, now my variable is sales revenue. My variable is sales revenue. So what am I going to do? If I'm looking at a variable like sales revenue, when I'm getting percentage, just a minute, guys. Okay, I'm back. Can you hear me? For sales revenue, my percentage change will be equal to, what is NPV? What is NPV? NPV of the project is 1,300. That is NPV of the project, 1,300. So I get that 1,300. I divide by, what is the present value of the test variable? Here the test variable is sales revenue. What is the present value of sales revenue? What is the present value of the sales revenue? Present value is what?
Yes,
of the sales revenue? 50,000. 50,000. This is 50,000 at 0.25. Then times 100. What do you get?
Excuse me.
Yes.
I have a question. What do you depend on to know that that is the test variable?
What do you depend on? You depend on what the examiner has told you. Okay? Like now, for our parts, we have all these ones are test variables.
Okay.
Each one of these are test variables. So if you are looking at variable costs, the test variable will be variable cost. So you will be asking yourself, what is the present value of the variable cost? Is it okay?
Yes.
Okay. Then here, what do you get? The percentage? The percentage, what do you get? If you get this figure over this, what do you get? One of the topics I like is the sensitivity analysis. Very, very easy. By the way, AFM is one of the easiest subjects you have, I think, this semester.
We get 2.5.
Pardon?
2.5.
2.5. Round off
Nine,
to
two
always
point.
round off 3 decimal points if you can.
Okay, it's 2.59. 2.599.
That is percent, percent. If you multiply by 100, you get this,
Yes.
Okay, so what does this one mean? The question is, what does this one mean? Because here it's not just a matter of calculating. You will not get these marks. If you see 10 marks, don't think that they can just give you these 10 marks like that. You need to comment. You need to comment. How is it sensitive? How is it sensitive now? Now, we are going to say that because it is only sensitive if it can change the decision, if it can change your initial decision. Your initial decision was that I can invest, I can undertake this project, I can go ahead and invest in this project because it has a positive NPV. But at what extent can you change that decision? To what extent? We need to look at now the change. The change in the sales revenue. We are going to say that for the decision to change. For the decision to change. For my decision to change, the previous NPV, the previous NPV must do what? Because it was positive. So it means that for that decision to change, that NPV should become 0 or should become negative. Okay, so for the decision to change, for me to change the decision, the NPV must fall by what? Okay, must fall by what was the NPV? Must fall by 1,300. That's for the decision to change. Your NPV must fall by that very figure, the NPV itself. Okay. Now, what does this one? Are these figures in million, in 1,000, or like what? Let me see. Are they in 1,000, in million, or just like this? Okay, since examiner didn't clarify, okay, you just do like that because here we don't have the sign. So for the decision to change, my NPV must fall by this. Okay, but for this to happen, for this to happen, or for this to occur, 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 we are saying that the sales revenue, our parameter, our test variable, our sales revenue must do what? Increase or reduce? Because here, you need to know what is the impact of revenue on NPV. Does revenue increase NPV or it reduces NPV? Okay, so here for this okay, remember you want to reduce NPV. So for me to reduce NPV, I must also reduce the sales revenue. For this to occur, sales revenue must reduce, must fall. or reduce by what? By 50, by 50, by this. Or you just say it must, for this to occur, the sales revenue must fall by 2.5. You just use the percentage, don't use the amounts. You just put this must fall by this. For this to occur, sales revenue must fall by or reduce by that percentage that you have computed. You have computed. Okay, so that is, if you want in terms of amount, you get this figure times the sales, So so that's how you comment. That's how you comment. That's how you comment without using much words. I think it is very easy. Just that you need to know if you're talking about inflows. If you're talking about inflows, for inflows, for you to reduce NPV, the inflows must also reduce. Then if you're talking about outflows, for you to reduce NPV, then outflows these ones must increase, must rise. The outflows, the costs must increase for NPV to reduce. For NPV to reduce, if you're talking about costs must what? Must increase. So you need to just know those kinds of words. Okay, when we are talking about the next part. The next part is what? We are done with that Roman 1. Roman 2, variable cost, do the same. Simply say for variable costs, that is Roman 2. Roman 2 for variable costs, What is the percentage change? What is the percentage change? What is the percentage change? You use the same formula, NPV over present value of a test variable. Here, the test variable is variable cost. What is the present value of a variable cost? So here I'm getting the NPV, which is 1,300 divided by the present value of the test variable, which is variable cost. What is the present value of the variable cost? It was given direct spoon feeding here. Maybe students had not performed well in coursework. So this is 25 for 475. 25. This is 25 475 times 100. What do you get? Put some speed, guys. Time is taking me. Put some speed.
103.
Pardon?
5.103.
5.103. Perfect. Now you comment. Just write something small. Write something small. Your accountant, so you don't need to be like literature students who normally write the organ. Okay, here we are going to say that for the decision to change, For the decision to change, I'm using just a simple word. The NPV must fall by 1,300. Okay. Okay. But for this to occur, now look at for this to occur, the variable cost must do what? Must increase or must fall? Must increase or must reduce? Who can tell me? These are costs.
Must increase.
So these ones must increase, must rise or increase by what? By your percentage.
5.103.
5.103%. Okay. And you are done. You are done. You're done. You are done. Okay. You do the same for others. You do the same for others. There is a document that I sent in your group about sensitivity with questions and answers. Those who are in a group, you may have time and go through it as well. I don't know whether you have that time. Then Roman 3. Roman 3 is about what? Roman 3 is about which one? Roman 3 is about fixed. Roman 3 is about contribution. Test variable here is contribution. The test variable here is contribution. So here you are saying for contribution, the percentage change. The percentage change is equal to what? The NPV, which is 1,300 divided by what is contribution? What is the present value of contribution? What is the present value of contribution? Someone has a question in the chat. Let me see. Okay, 24550. That is a value. The contribution. Let me hope you gave me the right figure. That is the contribution. It is here. The contribution. The present value. It is here. All right. So then times 100. What do you get? What do you get? Put some speed, my friends. Put some speed. What did you get? I don't have a calculator here.
5.2.
5.2.
295.
Around of 3 decimal points.
It's 5.295.
Okay. So their comment for the decision is a contribution an inflow or an outflow. For contribution to change, the NPV must fall by what? By 1,300. For this to occur, contribution must do what? Contribution must what? Rise or fall? Contribution must increase or reduce? Who can tell me? It's an inflow contribution. The same way you comment on the sales revenue should be the same like contribution. So the contribution must fall, must reduce by the percentage, by this percentage, 5.295%. All right. All right. Then number 4. What do we have? Number 4. Roman 4. Roman 4 is about what? Roman 4 is about fixed costs. Now the test variable is fixed cost. The test variable is fixed cost. So you are also going to get the percentage change. For fixed costs, percentage change is equal to what? NPV, which is 1,300 over what is the present value of fixed costs? What is the present value of fixed costs? It is, do we have fixed costs? 18,225. It is here. 18,200. 18,225. 18,200 is going. 250. 250. Sorry. 250, 225. Let me see. 250, I think. Yeah, 250. Perfect. When you multiply by 100, what do you get? Put speed 5.10. Put some speed.
It's 7.123.
Perfect. Then for the decision, comment for the decision, it's change. The NPV must fall. This one will remain constant. It can only, now you will use must rise or must increase if the initial NPV was negative. If the initial NPV was negative, then you'll be using the word must increase, must rise, because they are initially, it means that the decision was not to undertake the project. So how can you change that decision? We expect the NPV to increase for that decision to change. So depending on your NPV, if the initial NPV was positive, then you'll be saying for the decision to change, the NPV must fall. But if the initial NPV was negative, then you'll be saying for the decision to change, the NPV must rise or must increase, depending on what you want to use. Okay, so here the NPV must fall by 1,300. Okay, for this to occur, for this to occur, fixed costs must use. These are costs. Must do what? Be active.
Must increase.
Must increase always by 7.123. Okay, that's it. Then last, is it the last? Is it the last one? Let me see. This one was very easy. The initial investment. Initial investment. For initial investment, that is initial outlay. Initial investment. For initial investment, what is the percentage change? 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 Get the NPV over the test variable. What is the present value of initial investment? The present value of initial investment is that value is just the initial investment, because initial investment is discounted at year 0. which is always equal to 1, the discount factor. So the present value of initial investment will be just the initial investment, which is even given, that is 5,000. 5,000, it is here. 5,000. This is 5,000. So we multiply by what? By 100%. What do you get?
0.6%.
0.6%. Okay, for the decision it change. For the decision it change. NPV must fall by 1,300. For this to occur, the initial investment must do what? Increase or reduce. This is the cost. This is the cost. So this one must do what? Must increase, isn't it? Must rise by 26%. You're done with your these are 10 marks. 10 marks. You can score these marks within 20 minutes or just 15 minutes, because you'll be writing without thinking a lot. But you need to be aware that examiner know that these things are very easy, so you will always put some theory to disturb accountants. Accountants with the theory, some of us are not all that perfect. We know very well calculations, but we miss out on the theory. We miss out the theory. The higher you get used with the theory, the better. It will save you in the future. Because those guys don't want your calculation. They want the explanations. What is the logic behind? What is the logic behind the figures, not just presenting the figures. If you're working, it's not about preparing. It's about reporting and advising. Okay, so rank the variables in order from most sensitive to the least sensitive. Very, very easy. From the most sensitive. Very, very, very easy. Are you aware about this, how we handle this? How do we rank? Rank from the most sensitive to the least sensitive. If you look at the percentages, what do you think is the most sensitive one? What do you think is the most sensitive one? For you to know the most sensitive, okay. For you to know the most sensitive is the one with the lowest percentage. The one with the lowest, the most sensitive one, is the one with the lowest percentage. Because now, why do we say that it is the most sensitive? It can easily change your what? It can easily change that variable, that parameter can easily change the decision. That's why just a slight change, a slight change of that percentage can easily change all your initial assumption. If you were saying that I undertake the project and that variable changes by that percentage, then the whole of the decision will change. So when they say from the most sensitive, just start with the parameter with the lowest percentage, then move in that order. So you move in that order. From the most sensitive, you have all these 5. Start from the lowest to the highest. What is the one? Which variable has the lowest percentage from what we have? Looks like they are in order still. Here you have 2.5. This is 2.5. Then here this is 5. This is 5%. This is 7. You have this. Hey, are these the same? You see the reason why I told you you put it. Always round off to like 3 decimal points. Then here you have this. Then here you have 26. So I think these ones are already in order. They're already in order. So just list. Write sales revenue as you put the percentage in a bracket. Okay, here rank, you will just say, okay, here you will just say the first one. The first one is sales revenue. The most sensitive one with the percentage change, of put the percentage. Then number two, you also put number 2. It was what? The number 2 was what? Number 2 was variable cost because it has a lower percentage compared to this. So number 2, it is variable. The variable costs with the percentage change. With the percentage change of put the percentage like that. You put those ones. You put the fifth one will be this one, the one we had calculated at the end, which is the initial investment, because it has the highest percent. The initial investment with the percentage change of so put it like that. That's how you run. If they say from least to most sensitive, then you start with the highest percentage to the lowest. If they say from least sensitive to the most sensitive is the one with the lowest percentage. That's all about 10 marks. Hey, actually not only 10 marks. We are almost scoring 25. You have added these 2 marks. What are the weaknesses? Weaknesses of sensitivity analysis. They sometimes ask this as the limitations. Do you know the weaknesses? First of all, do you know the merits? Because next time they can say the merits. But weaknesses, let's start with the weaknesses as we cross in these remaining 10 minutes. The weakness of sensitivity analysis. The weakness of the sensitivity analysis. Who can tell me? What are the weaknesses? The disadvantages, the limitations. You can get points from that. Number 1 is that it looks at changes. It focuses on changes on one variable at a time. It focuses on only one variable. You see, for us, as we are commenting on every what? On every variable separately. So it means that for sensitivity analysis, it is based on only what? The analysis is based on one variable. But in real life, guys, in real life, variable variables change together. Variables change together. If you're talking about, let's say, sales, if you're talking about sales drop, or the decrease in the sales, you may also look at the what? The costs. You may find that sales have declined, but at the same time the costs have what? Increased. The costs have increased at the same time. And all that can change the what? The NPV. Can change the NPV. Not necessarily looking at what? Not necessarily you keeping the costs constant. Because for you, you are basing on the analysis, you're basing your analysis or you're basing on what? On sales, without looking at it, the costs at the same time. So what does this one mean? It means that the sensitivity isolates these other variables. Isolates other variables, which is not okay. You may find that sales, maybe the strategies you're using are not good. The market, the prices you are using not good. Maybe you want to price your products in a different way, but you're not looking at the costs. You may find that you need to buy the what? You need to buy the equipment. The landlord has said that the rent is going to increase next semester, because it's a political season. Okay. Okay. That is number one. Does not give. It does not give the probability. One of the weaknesses also, it does not give the probability of outcomes. It does not tell us what will happen. Does not tell us what will happen. It tells us, it simply, it tells when it can happen. When it can happen. When the decision can change. It tells us when can the decision change. But not how likely the change is. Making the results less reliable. You're just telling us, this sensitivity analysis tells us that you look here, that if for this decision it change, the NPV must reduce or fall by this. And for this to occur, initial investment must rise by what? By 26. But what's that? You're just telling us what can, at what point can this change? You're not telling us how likely will it be. We are going to change the decision, yes, but now, what will be the outcome of that? What will be the outcome of that? If we go ahead and maybe not undertake the project, what will happen? It doesn't tell us that. Okay. Then next, what else? It depends. The results depend. One of the results depend on the quality. Depend on the quality of the assumptions. Because here, if your assumptions are not also okay. Okay, we are going to say that. How can I phrase it? If the initial forecasts are wrong or biased, the entire sensitivity analysis becomes unreliable. becomes unreliable. You see, we have estimates that we normally use in this as we determine sensitivity. First of all, one of the estimates is the discount factor. The discount factor you are going to use to discount the cash flows. It is an estimate. You just estimate that the cost of your capital is going to be this. That is an estimate. So if it's wrong, if it's biased, then everything will be what will be not everything will be wrong. Will be wrong. Even as you forecast the costs, as you forecast the inflows, if the forecast or if your assumptions are wrong, if what you're saying is wrong, then automatically everything will be unreliable. Then it can be time consuming, can be time consuming. Just imagine you're analyzing one variable. Many variables here. Many variables must be tested individually. You don't aggregate, especially in large projects. Because in large projects, you cannot just rely on one variable, on one test variable. You will end up making wrong decisions. So many variables must be tested individually, especially in large projects. Increasing the workload. This one increases the workload and time. Okay. And also, one of the weaknesses as well is that it does not show interrelationships. It does not show the interrelationships. What does this one mean? It assumes that variables are independent. Assuming that variables are independent, yet in reality, things like sales, costs, and maybe the inflation, mention them, may be linked. But this model or this analysis looks at each separately. Looks at each separately. Okay, let me hope you're picking these points very well. No clear decision rule. No clear decision rule. How? Now, what do we mean here? One of the weakness for this is that it tells you how sensitive the project or the variable is, but does not say whether to accept or reject it, the project. Because here we are saying that okay, this is sensitive, this is most sensitive, and it will end up now here you will get a negative NPV or NPV which is 0. But the question is, can you go ahead and accept? Can you go ahead and accept or reject? This model does not tell you that. It just tells you how sensitive is this project to the variables, but it does not give us the decision rule, whether to accept the project or reject the project. So it means that you will need to apply other models to accept or reject, or you need to decide as a manager who is using this model as a finance manager, as an accountant, as a CEO, you need to sit down. Okay, from my parameters, from my variables that I have, this is the most sensitive. You analyze them, then you make the decision based on the analysis. You're the one to decide, can I go ahead and reject or I accept? So, but the model does not tell you whether to accept or reject. It is not like NPV. It is not like NPV. NPV, for it shows whether to accept or reject. It has a rule that if NPV is positive, accept the project, as it will add the value to the shareholders' wealth. Okay. Then what else can we? What else can we add? I think these points are enough, but you may add. One of its weaknesses, as well, might give false confidence. Might give false confidence. How? Managers may rely. The manager may rely too much on the results, even when the assumptions are unrealistic or uncertain. For you, you're just testing whether something is sensitive or what, without looking at other things. That one can affect you. Also, one of the weakness is that it does not protect or eliminate. It does not eliminate the risk. This analysis does not eliminate the risk. It doesn't eliminate the risk. It only identifies the risk, but it does not reduce or eliminate it. Then maybe you can say it is subject, it can be manipulated, it can be manipulated. It can be manipulated by managers. It can be manipulated. Results can be influenced manipulated by what? You as a manager, you may decide to look at the favorable ones by looking at the favorable or unfavorable ranges for the variables. You may decide, because it is judgment, it is something which is judgmental. You may decide basing on your mission as a manager, basing on what you want. You may find that you are not familiar with how to run the kind of project, and you come up with the sensitivity analysis and tell the board that, you see, the board, this is very, very hot. This is very, very sensitive. It might not give us good results. You just say that out of how I have ranked my variables, you can see that indeed the costs, we may not be in a position to manage. Of which, sometimes you need to dig deep and come up with the appropriate decision, not just relying on this model. So you may choose basing on basing on your line, basing on what you want as a manager, you may choose variables which favor you. Because still for variables, you see like here, examiner has given us these variables. Examiner has, this is what examiner has told us. These are the variables. Another person can choose other what? Can choose other variables. So I can choose variables that favor me. I can choose a variable that favor me, that gives me a better position. Because we have many variables. Someone can look at cost of equity as a variable. Okay. Okay. I think those points are really enough and easy to recall. But do you think it is easy to for everyone? Do you think a non-manager can understand this? Difficult for non-finance managers. It is not for everyone. It's not for everyone. Take it to people who are doing Swahili. But so some of those ones are smart as well. But okay, it is difficult for non-finance managers. It is difficult for non-finance managers, especially in terms of interpretation. It may require interpretation skills that some managers do not have. Okay, so if you are not familiar with this, obviously it will be hard for you to use this model. Any question?
Excuse me, sir.
Yes.
When we go back to when you said it depends on the NPV of the project when commenting, does it mean that, for example, if they told us initially the project has a positive NPV, does it mean that if we had to comment, like, for example, let me use initial investment, if the NPV was negative, this one we are supposed to say that the decision, in order for the decision to change, the NPV must rise by that amount.
Yes. If your initial NPV was negative, you use the word rise or increase.
Yes. Then what about for the issue of the initial investment down?
Now it will be opposite.
That the costs reduce and then the inflows increase.
Yes.
Okay.
Just the opposite.
Okay.
If you use here 4, then it means that here you are going to use rise. That is if you are dealing with the costs. But if you are dealing with inflows or the NPV, for NPV to fall, even your inflows must reduce. But if you're if you want to increase NPV, just under you see, the moment you study these things and you are cramming, it will be hard. From my experience, it becomes very hard to master. So for you, just understand it from this way. How can I increase NPV? Remember, to get NPV, you are looking at revenue minus costs. Okay? Technically, the present values of revenue minus the present values of costs. Then overall, you subtract initial investment. Okay? So, in my mind, I should be knowing that for NPV to increase, when I look at revenue must also increase. If I have a higher revenue, NPV will also be high. If I have a lower revenue, NPV will be low. So there it becomes easy for me to even comment. How can I reduce NPV? I need to reduce revenue. I need to increase costs. Because the more the costs, the lower the NPV. Hmm?
Mm.
You just, from your accounting bit of it, sales, cost of sales, RS expenses, you understand. Eh?
Mm.
Okay, guys, I think that's enough.